Today, President Obama said China's yuan is undervalued, though China has made progress on currency revaluation. Joining us for now to talk about this is Jing Ulrich. She's chairman for China equities and commodities at JPMorgan Chase. Jing's insight into China won her a spot on Forbes magazine's list of the world's 100 most powerful women. So, Jing, great to have you back on Bloomberg.
Thank you very much.
You know, we've had a few days to kind of mull over what the Chinese did this past weekend. Is it as significant as many folks were thinking over the weekend and on Monday?
Well, I think we need to take a longer-term time horizon. We know the currency is not going to move today or tomorrow. However, over the next several years, I think the RMB will appreciate probably by 4 to 5% on an annual basis. So this is a longer-term picture rather than a short-term move.
What do you think about what we're going to see for the revaluation? I mean, how much was my immediate question when I read the reports that they were going to at least widen the band a little bit. How much do you think we're going to see the move?
Well, I think the move will be gradual and incremental. The announcement that came out a few days ago was largely symbolic. It basically shows the intent of the Chinese government to let the currency appreciate. However, they didn't say by how much. They also ruled out the possibility of a one-off revaluation. So therefore, I think what we can expect is a gradual, incremental move that will happen over the next several years, probably 3 to 5% per annum.
You know, I think there are U.S. investors who say, why can't they just do this overnight? I mean, what is it that you think U.S.-based investors don't necessarily understand about the process and the way things work over in China when it comes particularly to their financial markets, to their currency?
That's a very good question. You know, the Chinese exporters are under a lot of pressure already. Think about the coastal region. Wages are going up by 20-30% on an annualized basis.
Still low, but those are big moves.
Well, you know, but the margins of the exporters are already very low. They're earning 1 to 2% margins. So if the currency appreciates too dramatically, you're going to see widespread problems among the exporters. Of course, the global economy is not yet on a sound footing. So therefore, the leadership is very concerned about the state of the export sector. Also, on top of that, if you think about what China is doing with its currency, foreign currency reserves, it has some 2.4 trillion US dollars of foreign exchange reserves. If the RMB appreciates too dramatically, that means China's reserves will be worth a lot less in RMB terms. So a lot of domestic considerations and international considerations. So basically, don't expect anything too drastic in the near term.
Let's shift the focus a little bit to Chinese equities. They've had a rough couple of months here, especially compared to some of the other indexes in the region. Let's talk about what we could look at going forward. I mean, a lot of people are saying that's a buying opportunity, guys who are bullish, obviously, on China. But you don't really see a real large amount of appreciation for Chinese stocks going forward, 4 to 5% annually.
Well, I think there's no catalyst in the immediate future because we're seeing domestic equities treading water in the last several months. That is because the Chinese macro policy has shifted fundamentally from last year's ultra-expansionary stance to this year's tightening stance. So that basically affected domestic investor sentiment. At this point, Chinese equities are among the cheapest in the world. They're certainly among the worst performing in the world. So valuation is becoming more attractive. But for the domestic stock market to go up, we need a catalyst, which is liquidity. Liquidity right now is being reined in because of the government's fear of inflation and asset bubbles.
But you must expect surely GDP to be higher than 4 to 5% annually over the next 10 years, right?
Absolutely. But remember, there's never a direct connection between the country's GDP growth and the stock market performance. In fact, there's often been a disconnect between GDP and the stock market performance. So in the past many years, China's GDP was growing at 8 to 10% per annum, but the stock market was a lot more volatile.
Why is that? Why is there such a disconnect? I understand about the volatility, but that's a huge disconnect.
Yes, the reason is that what drives domestic stock markets is liquidity and sentiment. It is very much a market dominated by retail investors. Institutions only play a very small role. So as a result, sometimes there's a disconnect between fundamentals and the stock market performance. And the most important driver of domestic stocks is liquidity, is monetary policy. And monetary policy clearly has shifted from an expansionary stance to a tightening stance.
Got a few seconds left here. I'm curious then, what would be your advice to investors looking at the Chinese market? There are a lot of opportunities. What is, though, the best way to play it in your view?
Well, there are many different ways to play China. You can invest in resource stocks in Australia, in Brazil, that sell resources to China. You can also invest in Hong Kong stocks, which are now trading at 12 times PE. So think about multinational companies as well that benefit from China's tremendous growth in the consumer market especially.
What about buying an apartment in Beijing?
Yeah,
well, that too, but maybe wait for 3 to 6 months because the prices are falling. So by year end this year or beginning of next year, there should be a good opportunity to buy into the property market.
All right, which is the plus side basically of what China's doing as far as the tightening. You think they've gotten basically the property bubble under control. Jing, thanks you so much for spending some time with us.
Thanks very much for
Jing
having me.
Ulrich there with JPMorgan Chase. We're going to take a